let's continue. Adjusted present value model. So Hyoung-Goo Google site teaching uh, alternative investment, adjusted present value, and then here, yeah, the second lecture note, APV lecture note, this one. Okay, it has some link. We have very good Harvard business case. You can buy this one. Okay, and then yeah, and then second we have code, example code. This is a code for this Harvard business case. Okay, so this Harvard business case, it is what, per student, for student you have to pay $4.5. Okay, then you will get a PDF file. Okay, so this one, using APV, a better tool for valuing operations. Okay, and then actually I implemented this one using Python with this one. In Before we go into the code, okay, I told you APV is very important. APV is very important in the private equity, more generally alternative investment, and I explain in detail why APV is important in alternative investment. So APV, adjusted present value, becomes particularly important and often a preferred valuation method when analyzing alternative investment due to the inherent characteristics of these asset classes and nature of their financing structure. Here's a breakdown of the why. Okay, significance and dynamic financing effects. Okay, first, leverage is frequently used. Many alternative investments, such as private equity, real estate, infrastructure, and project finance, heavily rely on leverage. With the formula, why why when leverage is high, APV becomes particularly important. Why it is important in separating the value creation by operational engineering and then financial engineering. Okay, so because using that is such an important for private equity managers, like project finance managers or infrastructure like project developers, they have to be very good at financing strategy, very good at financial engineering in order to create value. And then APV is one way of measuring the value creation. Therefore, you have to do simulation with APV to design the financial strategy. Okay, so for alternative investment, although actually I met many people in alternative sector, they have no idea about APV, but you have to know this. It is actually very important. So that is just a minor component of the capital structure, not just a minor component of capital structure. It is often core element of investment strategy, the very way of creating value. Okay, so that's why it is important to use APV. Second, well, you have to optimize the tax. Okay, tax optimization crucial. Alternative investment is often structured to maximize tax efficiency, and debt finance plays a key role in generating tax shield through interest deductibility. So when you design alternative investment or alternative project, debt policy is important, tax policy important, and they are interlinked. Well, the tax strategy is sometimes the very reason of doing like LBO, private equity deal. Some private equity deals are purely for this tax optimization. The value of this tax shield can be substantial and significantly impact the overall investment return. Okay. Next, dynamic capital structure. Unlike a typical publicly traded companies that might maintain a relatively stable target capital structure, alternative investment often have dynamic debt level. Dynamic debt level, because why dynamic debt? Why debt level change over time? Because that's the way they create value. If it is stable over time, they are doing nothing. Okay. First, private equity. Leverage is added at acquisition, and the debt is often repaid or restructured over the investment horizon. For private equity, how to use debt is one of the core strategy of value creation. Again, there are three ways private equity creates value: operational engineering, financial engineering, and governance engineering. This part is financial engineering part. Well, by separating out financial engineering part, you can also have clear idea about other part: operational engineering and governance engineering. Okay. Next, project finance. That is typically amortized over the life of project with the debt level decreasing over time. In project finance, by definition, debt is dynamic. It is not stable. It decreases over time. Therefore, we have to take into account that in valuation. So in that case, we have to use APV. Although in many private project financing document, I saw they simply use NPV. That's completely wrong. Okay. Now, real estate development that may be used for construction and then refinanced with different terms upon completion and stabilization and bridge loan, blah blah blah. Okay, real estate development, that is very important. Now, hedge fund. Well, hedge fund is a bit nuanced. Okay, while not always directly investing in assets, some strategy like a distressed debt, like credit fund. Some hedge funds deal with like they are debt oriented. Some hedge funds are specialized in debt, okay, or credit. Then they have to use APV. Heavily utilize leverage and are sensitive to financing costs and tax implications. Okay, so it is straightforward why APV is better than weighted average cost of capital here. Okay, well, WACC, weighted average cost of capital. Um, well, weighted average cost of capital WACC as most accurate when the target capital structure like debt to equity ratio relatively stable and known. It well, even when it is relatively stable and known, cost of debt can be dynamic, right? Depending on equity price or from strategy. So even in that case, I don't think WACC is a good idea. Anyway, it blends the cost of capital and tax method into a single discount rate. That is the problem. Okay, so when capital structure is dynamic, using a constant weighted average cost of capital becomes inaccurate. And the APV explicitly separate the value of operation VU from the value of financing effect PV of financing effect. This approach is crucial when financing is major and changing value driver, which is true in many private equity deals or even venture capital deals sometimes. APV allows you to model the tax shields and other financing benefits based on the projected debt schedule. So you have to model that, which means you can, well, on the other hand, you have to model that, which means that on the other hand, you can take into account your financing strategy, that strategy into valuation equation. Then you can simulate the effect of your financial strategy, not a static target ratio. Um, yeah. Other financial benefit based on project. Okay. Now, second, project specific. What's wrong? Okay. Project specific financing and valuation. Okay. Now, okay. So, yeah, about project specific financing valuation, project finance dominance. Okay. Infrastructure, like why APV is important in alternative investment, because sometimes alternative investment is very project specific. So project finance dominance, infrastructure, energy projects, and some real estate developments are often financed through project finance. Project finance is characterized by, okay, These three things. Okay, so let's move this one level up. Okay, so our characteristics of project financing is that raises specifically for a single project, often non-recourse or limited recourse to the sponsors, and that involve complex debt structure and amortization schedule tailored to the project cash flow and optimize debt tax, right? So strong reliance on project ability to generate cash flow to service debt. Okay. Second, standalone valuation. Alternative investments are often evaluated on a standalone basis. You are valuing a you are valuing a specific project or real estate property or portfolio of private companies, not necessarily entire operating company with a long history established capital structure. It is more like a specific based. That question is why APV is better than WACC here. Okay, so here the reason is that WACC is like a company centric. It is usually, well, in textbook we know WACC should be project centric too, but it's typically company centric. Well, there are many organization problem. Okay, well, if you apply lower WACC to some division and high WACC to some division, well, some people say it is unfair. So in a company, they often use, because the organizational dynamics, organizational characteristics, WACC is often company centric, like a single WACC. It is not right. So it is typically driven using a capital structure on the bet of a comparable company, entire company. Applying a company level WACC to a specific project, especially with project specific financing, can be very misleading. And APB is naturally project centric because you have to take into account your financial strategy in valuation. VU is calculated using unlevered cost of capital, reflect the business risk of project itself, independent of financing. Okay, then the financing effects specific to that project debt structure are added separately. This makes APV more accurate for valuing individual projects with unique financing arrangement. So the complex deal structure and the tax consideration. Okay, that's another reason why APB is good for use for private equity or alternative investment. Intricate legal and tax structure. Alternative investments often involve complex legal entities like special purpose vehicle or partnership and offshore vehicles designed for tax optimization. They make that kind of special vehicles for tax optimization and the risk allocation, of course. Then that is like financial engineering, value creation by financial engineering, and in order to capture that, we have to use APV, right? The variety of financing instrument beyond the simple bank loans, alternative investors might use mezzanine debt, convertible debt, preferred equity, and other complex financing instrument. Okay. In this case, why then APV is better than WACC here? Well, WACC is less transparent about the individual effect of different finance component, right? We cannot separate out. Well, theoretically we can, but in practice it is hard. So WACC is less transparent about individual effects of different financing components. It combines everything into a simple discount rate, one discount rate, making it harder to isolate. Theoretically, it's possible, but in practice, it is very, very hard to isolate and analyze the value contribution from specific tax strategy or financing strategy or instrument. Next, APV is modular. Okay, we separate value creation. We separate out the valuation into the value creating part, right? So APV's modular approach allows for more granular analysis. You can separately calculate PV of tax shield, potentially PV of subsidized debt, and even negative financial effects like financial distress cost if relevant and quantifiable. This transparency is valuable when dealing with complex structure and evaluate the impact of various financing decisions. Number 4, illiquidity and valuation challenges. Limited market data. Alternative investments are often illiquid, with less frequent transaction and less readily available market data for comparable valuation. For example, house. You cannot sell house like you trade like Nvidia stock. Okay, it when you trade house, it is much more costly. That cost is liquidity. Okay, liquidity cost. You have to pay liquidity cost. Okay, so limited market data. Okay, so it is often illiquid, so you cannot easily get the data, and the illiquidity is a bigger problem. So valuation subjectivity. Valuation can be more subjective, therefore, in alternative investment and rely more on discounted cash flow analysis. The market comparable may be scarce or not directly applicable because you don't have enough data. Then why APV is better here? Okay, straightforward. In illiquid market, finding truly comparable companies for WACC calculation can be challenging. Relying on industry average for WACC might be less reliable. APV is different. APV is focused on project-specific cash flows, and discount rate can be more robust when market comparables are limited. So you don't have enough data. When data is limited, actually APV is even better. Okay, you can focus on estimate the unlevered cost of capital based on bureaucratic asset class itself, and then meticulously model the financing effect. Number 5, long investment horizon and changing risk profile. Long-term investment. Many alternative investment like infrastructure, real estate, private equity have long investment horizons spanning many years or even decades. And then next, risk profile evolution. The risk profile of alternative investment might change significantly over its life cycle. Okay, for example, a real estate development project risk is higher during construction than after it's stabilized and generating rental income. Okay, then why APB is more better? Because it is more flexible in this case. Okay, so WACC, once calculated, often used as a constant discount over the entire project period. This might not be appropriate when the risk profile of capital structure changes significantly over time, especially in long-term projects like alternative investment. APV allows more flexibility in adjusting discount rate. You can potentially use a different discount rate for the unlevered cash flow and for the tax shield, and this rate can even be adjusted period by period, no problem, if the risk profile is expected to evolve. In summary, APV's strength lies in its ability to disentangle the value creation by operation from the value added, and then value added by financing decision. You can disentangle value creation by operation strategy and then value creation by financial strategy. This separation is particularly crucial in alternative investment where financing is a significant and dynamic value driver. It means financial strategy is very, very important as alternative investment, especially private equity there. And the valuation is often project specific, and deal structures are complex and tax sensitive, and market data is limited, and valuation are more reliant on fundamental analysis. So while WCC can be suitable for valuing stable, mature companies with a predictable capital structure, well, usually, but in this case, in this kind of case, we don't even have to do the valuation in many cases. Okay, because we have many data, transaction data. APV provides a more robust and insightful valuation framework for the open, complex, and financially engineered world of alternative investment. And alternative investment, financial engineering is important, and we want to calculate the value of financial engineering, and APV can allow that. Thank you.